Well, just to make sure that everybody get a green slip. That's the evaluation for this young man right here, and we need that to know what we need to do better next year and what we're doing good right now. This man was raised on Hart Mountain. He was educated in Kyle Public Schools. He attended Northwest College and graduated in 1970. He farmed on Hart Mountain from 1973 to 1980. This gentleman is currently the Farm Bureau agent in Powell, has been since March 1st in 1987. This man's topic for you today is risk management of crops, livestock pasture, rangeland, and forage. Ladies and gentlemen, Larry French.
Thank you. Like he said, I am a Farm Bureau insurance agent, and I will never apologize for making my living that way. However, the topic that we're doing today is basically about risk management agency. And so because what we're talking about is a government program, you can find online, they're showing you here, other agents. There's John Deere, Rural Communities, Rain and Hail. There's probably, how many are there?
16.
16 different companies that handle the RMA paperwork. So if there's something that comes up in this presentation that's specifically about Farm Bureau, I'm not here to solicit your business today. If you want to call me later, that's fine. So actually what I'm going to do is kind of give you a brief overlay, and I've got John here to correct me if I'm making any mistakes. Most of what we sell is livestock risk protection, which is like an out-of-the-money put. You can literally buy insure one head or up to 2,000 calves, 4,000 fat cattle, lambs, hogs. The only ones we've ever done are feeder cattle, fat cattle, and lambs. We've not sold any for pigs. There's not a lot of pigs in here. There's livestock, LGM, livestock gross margins. I've never sold one of those. They have that for dairy. Fairly complicated unless they change the program. Not a lot of that sold. Pasture, rangeland, and forage. What that is in Wyoming, it's rainfall index. It's vegetation. Satellites fly and map the country twice a month. They take the best photo and figure out on a 3-month basis if it's below normal or above normal, if you have a loss or not. Then most of what we sell in this area, both spring and fall, are what they call the APH programs, average production history. And there are revenue products that are mostly on grains. Corn is one, for example, and basically what the revenue does is it insures dollars per acre instead of bushels at a price. So it's got a harvest price and different kinds of things. So, where would you like for me to start? We can go on for hours and hours and hours, so I thought it would be better to tailor it to what you guys might like to see.
I'm interested in the feeder cattle
Okay?
insurance, if that's...
What we're going to show you, we're on the RMA Risk Management homepage. You come right here to the livestock, well actually down here on the cost estimator. You can see that's just got the little thing right in there. So if you go to www.usda.gov to the homepage, you can find these things. Okay? At first you go, God, how'd they do this? But as soon as you walk through this program one time, it's really pretty user-friendly. So you want to look at feeder calves. Okay. The way this thing works is you can buy them 17, 21. They're 13 weeks is the least amount of time. And it was 13, 17, 21. And technically, you can go clear out to 52 weeks, but that doesn't happen very often. So on this, what this does, like I say, it's like buying an out-of-the-money put. So it's putting a floor on your calves. The only risk that you have is the premium that's due when the policy is written. So let's do the LRP, Betsy. You want, now there's two ways you can do this. You can do steers weight 1, which is under 600 pounds, steers weight 2 up to, we don't sell anything over 900.
69.
Then on the on the fat cattle, it goes higher.
Sure.
So, what would you like to see?
Up to 6.
So the light
Yeah.
steers weight 1?
Yeah.
Okay, now these prices, this effective date, those were the prices for yesterday. Today's prices won't be available until after 3 p.m.
Okay.
So we're going to be going off of yesterday's prices.
So what happens is, let's say you're watching this and you're watching the trends and you're going, okay, I need $1.41 to be basically where I figure I can make a profit.
Mm-hmm.
I'm going to be out 13 weeks or some such thing. You gotta be really careful because this thing can swing quite a bit. If it's if it's below the target price or above it for 2 days in a row, it kicks off until it stabilizes itself. So it can just go off.
Okay.
And then it shows all these government holidays that they're not open.
Mm-hmm.
Okay? Let's see. Oh yeah, okay. See, here's your length of endorsement, 13 weeks, 17, 21, 26.
Here's TP.
We're down here to 30,
There's
and one at 34 weeks.
And that's figured from when the calf was born or when you start the
No,
policy?
that's from today.
Okay.
Okay. So on a 13-week endorsement, laser printer.
Can we shut the lights off in the front?
Yeah, you
of the
bet.
building today?
Yep.
That's the, don't
next line.
touch that one, that's the notes.
There you go. That's it.
Oh, much better.
Can you zoom us in more, Betsy?
What's that?
Can you zoom us in more? Or am I the only one who can't see that?
How's that?
Oh, yeah.
Okay, you can see the length of endorsement here. So if you bought a 13-week endorsement, the closing date is going to be April 24th. Okay?
Which means you would have to sell your animals before that date?
No.
Or you're just locked into the price? for
You're
that
just
day?
locked into the price that day. Now, what they do on those calves is you can sell these calves 30 days before this end date and still have the coverage. You can. It doesn't matter what you do with your livestock. You do not have to sell them. You can eat them, you can sell them, whatever. It does not cover death loss. So you want to be really careful. If your feeder calves, you're going along there and you normally have a 2.5%, 3% death loss, you don't want to buy 100% of your,
Mm-hmm.
because if they die, it's just tough. But, so you can see here that on these calves right here, you can do 98.67% of the market price, which is right there. So 98.67, you can lock these calves in here. Most of my producers take the top one. However, I have several producers that figure it up and they say, okay, my break even is $1.54. These are all in hundredweight, so it's $154 per hundred. But look at the difference in the price per hundredweight.
Yeah.
So you can get an awful lot of coverage right here for hardly any premium. So let's look at these 17-weekers. We're going to do the same thing. So these go clear up at May 22nd. And so here at 94% is $158 for $1.42, and 167 for $4.41. So it just depends upon what you're trying to do. This whole thing is to manage your risk. How much risk are you wanting to manage? Are you wanting to manage it for profit? Are you wanting to manage it for break even? What is it that you want to accomplish by purchasing this policy? Now, We're gonna show you on these, this one here to 98 point. Gotta be smarter than the machine. Okay, Betsy, so somebody write down 162.8, now let's switch to heifer. You can insure heifers, which is a cool thing, because if you're buying feeder cattle futures, they're all based on steers.
Mm-hmm.
So it's hard to get it accurate. Now, what you'll also understand here is that in the real world, heifers are what, about a nickel difference?
Diamondback 8 cents, yeah.
Look at the difference here. Almost a dime.
20 cents.
20 cents, yeah.
Yeah, 20 cents, oh yeah. But it's still the same here, but that coverage is quite a bit different. We don't sell a lot on heifers.
Mm-hmm.
However, in 2008, every single one of these policies that we wrote, we paid a large indemnity. I had a young man who covered both his heifers and his steers. They averaged $125 a head indemnity, which I'm telling you, anybody, if you're handing $125 a head over what you sold them for, or whatever, it couldn't be making your cow payment or not. Okay, so, and then of course, because this coverage price is lower, this price is going to be lower. So it's kind of a two-way street there.
Mm-hmm.
Now, part of what can happen to you on this is if you're buying a 50,000 pound contract on the futures, which is fine, you're either going to be gambling because you only have 80,000 pounds of beef you're going to sell, so you're buying two, or you're only going to buy one and you're short. Where these can fit exactly what you're trying to do. Here a couple years ago, we had put a presentation on for Carbon County, Stillwater County Cattlemen's Association. I went first and made this presentation, and a PhD from Montana State gets up there, and I'm thinking, I hope I knew what I was talking about. And what we found out was, from his presentation and mine, if you're at 50,000 pounds, it's almost a wash. Might be a little bit better to go by a foot. But I don't know any cattle operation that
That's exactly
hits
that.
50,000 pounds.
Yeah.
So, and they came out with this for the smaller producers, for 2,000 head and less, because more than that, basically, guys, you're gonna, if you've got 10,000 head of feeder cattle or something, you're gonna be doing different than this anyway. But it's a very good program, works very well. So, let's go to the steer's weight 2. I'll show you what that
Can I
was.
ask a question, Larry?
Okay, excuse me.
The actual contract is for, that one that we were looking at is less than 600 pound calves, right?
Right,
Up to 600 pound calves.
correct.
Does this encourage poor management of those calves?
No.
Because there's no parameters to say they've got to be, 5 weights at that point, or even 4 weights, they're just under 6. You know what I'm saying?
I'll show you, hopefully I'm going to answer that with this next slide. Okay, steers weight 2. These are over 600 pounds. So let's say that you market your steer calves whenever you do, and they're averaging 650. Okay? All right? Coverage price $1.48. And they were $1.60 what?
68.
Pardon?
$62.8.
Okay. This is your risk management. You can do what you want to. What's the difference in the price here versus the $3.50 or whatever it was on the other one? You could purchase, if you wanted to, the 599 pound coverage, even though you might be at 625 or 650 when you market them. If there's an indemnity, they're only going to pay you at 599 pounds. They're only going to pay you at 650 that you calves it. So again, it's just a management tool. Look at it, figure out the price both ways. If this one works better for you, do it. If the other one's gonna work better for you, fine.
And you have 30 days either way to ship calves. I mean, if your calves, if you have a good rain year and things are good and calves are good, I mean, you can ship a week or two early if you're getting up on that 600 pounds or what?
Has nothing to do with your
How do you
live
manage
cattle,
it?
except you have to own them.
Oh, okay.
You can market them any way you want to. If you market them more than 30 days before the end here, what you could do is, let's say you had a buyer on these calves that you normally, on these steers weigh 2, these calves, you lock them in at 800 pounds.
Mm-hmm.
But you're at 775 and you're ready to go with them. You've got a buyer that wants them, and you're March 10th.
Mm-hmm.
You could say to them, hey, I tell you what, for 50 cents a head, I'll sell you this, and we can transfer it to them. Correct?
Yeah.
What, I probably misunderstood you. It makes sense to me that I did. You said you can eat them, or it doesn't matter what you do with them. Replacement heifers. If the cash market's below the insurance price, what happens there?
If it's below, they're gonna pay indemnity.
Really?
Absolutely. So let's take this.
It's not necessarily the cash market though. It's
on the futures.
It's on the
all
futures.
based
Oh, it's on the board, okay.
It's not anything to do with the cash market.
Okay.
That the,
Okay.
you know, local price can fall out of bed.
Sure.
Or go through the roof.
Gotcha.
And it doesn't matter.
Okay.
It's only what happens with the board.
Based
Sure.
on the
Okay.
based on a 5-day average after the contract ends, correct?
Okay.
Of what the futures did that day. So Betsy, why don't we go back and to the one where we can pick last year this time, show them what the cattle settled at.
Or if you go in the middle of July, sometime early July, it'll show you what would happen if you shipped them this fall.
Yeah.
But the calves have to be on the ground. You have to have them. You can't.
They gotta be born, yes.
Right.
Okay.
You have to own them.
Now, so what's the end date do for you? After that end date, what happens?
That's when the contract is ended.
So you gotta decide what you're doing with them.
And you haven't decided what you're gonna do with them,
Mhm.
it's no problem. Like I said, it has nothing to do with your live cattle, it's all based on the futures. The only thing on that is that you have to own the calves when you insure them.
I understand, but at the end market, after that point, you're not insured anymore.
Correct.
Correct.
Correct. Yeah, on whatever day you picked. And this 13-week one was April 24th. On April 25th,
Right.
the contract's over. Correct.
So you could move on to a feeder or a fat cattle deal at
Yeah.
that point in time if
Here's what
you,
you
I mean,
can
a
do.
bit
You
of a
can
larger
say-
weight.
You could say, okay, now it's April 25th. I have made a management decision, I'm not gonna sell these calves.
Mhm.
I'm gonna back out them, I'm gonna take them to 900 pounds, buy another contract to 900 pounds. Comes to whenever that is, and you say, man, I'm not gonna sell these calves, I'm gonna ship them to Nebraska to a feed yard and put a fat cattle one on them.
Okay.
And then here's another thing you can do too.
Larry, what weight do you want?
Let's do steers weight too. I had a ranch that backgrounded their own calves. They had 1,000 head of cows. Everybody knows that 25% of the calves are born in the first part, and they're good doers and going to go good. Then you've got the 50% right in the middle, and then you got 25% of the late calves. So what he did is he bought a 13-week one endorsement for the top 25%, 17 weeks for the next 50%, and 21-weeker for the bottom 25%, because historically that's how he marketed his calves. So you can pick and choose, make it work. It's very, very flexible. This is the coolest program that we've worked with, in my opinion.
Easy.
Okay, so you can see right here, on October 22nd of 12, these calves, the actuarial value was here, and they covered them here, so there was no indemnity due. So the biggest risk could happen there on this one was they paid that premium. Now, if it were the other way around, this was the coverage price, and this was the actual end price. If you bought 600-pound calves and it was off a dime, you're going to get 60 bucks a head. They send you a little form. You say, Gwen, it looks like you may have an indemnity. Please fill this out, send it back, and they send you a check. I believe it's 5% of them are audited by the RMA. So what happens is if your number comes up and it's not sure that you own the calves and those kind of things. Okay, any more questions on this part?
Just a little clarification for the dumbhead here. Okay, we've got, let's say you got a load of calves, and you see that, and they're on the ground, and you see that the prices are really good today, but you think they're gonna tank in the fall, right? So the advantage to go ahead and buy insurance is that we can guarantee today's prices for those calves, right? Am I understand? And that would give us the insurance or the peace of mind to know that they were gonna be that way at the end of the contract, irregardless of where the market went.
Correct.
That's the idea of this
That's
insurance.
the whole thing, and it's all based on what you buy as coverage and what happens as far as when it ends. Like I said, in 2008, we paid every single one of these policies that we sold, paid indemnity. My ranch that I have that feeds probably 1,500 to 2,000 head a year, he calls it his sleep insurance. You take 1,000 head of calves at $600. They're arriving on your place and you got $600,000 in those calves, and you haven't fed them, you haven't vaccinated them, you haven't done anything yet, and the banker's going, let's see, $600,000 at whatever the percent in. How are you gonna feel about that? Woo. Well, the nice part of these is they're assignable. So you can go to the bank and say, I've got these calves locked in at $138. Our break even is we've got it figured is down here at 129. So we've got some margin in here as far as what we think we're gonna need to do. And Mr. Banker, would you like to have a assignment on these calves? And you're going, yes. It works very well.
There's always a possibility though, because this is on the board, there can be an anomaly in the local market
Yeah.
that it can happen, high or low. You can have a sweetheart deal with a processor and they'll give you more money for it. You can stick that in your pocket, the board falls, you get the indemnity as well. The inverse happens though too. Something happens local, they had a scare of foot and mouth 5-6 years ago in South Dakota. It was Russian olive trees. But that day that the guys took their calves to the market, it fell, and the board stayed high. So the local market was low. They sold them for less money than they thought they were going to get out of them, and they didn't get an indemnity. That can happen as well. So
that is one risk.
So these prices are based on local markets more than the national
no,
market?
no.
It's all futures.
This is all off the futures.
So if what
you
he's
switch
saying
over
is,
to the
if
steering weight one,
this 145 here, where they didn't have any indemnity,
Would you say?
those calves
Yeah, just right
locally,
there.
the day you sold them, you may have lost a ton of money on it, but this is saying, oh, wait a minute, that was an
I think there
anomaly.
was an indemnity on some of these.
We've had that happen to us one time in all the ones that we sold.
Or there was on maybe early. It depends on when you buy them. I think there was one that, like if you went, like the first couple weeks of, like the 2nd or 3rd of July, there was an indemnity due on some of those. If you waited till the end of July, there was no indemnity, but early July there was.
Yeah.
Like the 2nd maybe?
So you've done this a time or two, haven't you?
There you go.
Yeah, these ones here.
Yeah, see, there's no indemnity on this one either.
Yeah, there was.
Yeah,
There is.
Yeah, see, these calves ended at $1.57, and these, they bought them at, locked them in at $1.68. So on this particular one, they had an indemnity. So it's about a dime, fairly close to a dime there. So on 600-pound calves, we got $60.
And it cost them 35 or whatever.
Correct.
Correct.
Okay.
The 35 is due at the time of the sale of
Sure.
the insurance.
Yeah.
Now, what did you say about heifers again? Just now I'm understanding what's going on here. You say heifers won't insure heifers?
Yeah, they will insure heifers, but the price is less.
What is left?
coverage price on heifer.
Oh, I see.
So see, instead of being able to, this percentage would be the same, but the expected end value and the coverage price will be about 10 to 20 cents lower
Well,
than the steer.
Switch it over, 168 and 157, you should be able to see what the heifers ended up.
Yeah, see, they locked them in at $1.52. They got it, so they had an indemnity here too. It's, but this was what?
162.
15 cents cheaper. So,
Yeah.
It's just that they're not gonna insure the heifers for as much as they do the steers. And part of that reason is that it's hard because on the futures, they don't, I
Yeah.
don't know, there's gotta be a formula that I'm not aware of.
Well,
Run it clear to the packer end of, just so I can see the difference. There shouldn't be much variation between heifers and steers on the packer end.
No, and there's no,
Yeah.
on fed cattle,
Yeah.
they don't do heifers and steers.
Oh, don't they?
On fed cattle, it's just fed cattle. So if you've got heifers and steers, a pen of each, it's the same rate.
Okay.
If they're going to the packer.
They're gonna get rid of cattle.
there's also a difference in here if you go, when you go back, if you're looking at either heifers or steers, and those are beef cattle, or you can go Brahma influence, or you can go dairy influence cattle. So the prices are broke for that as well.
Just out of curiosity, where do they get their values then for the heifers, if everything's on the board?
It's gotta be a formula.
There's a formula and
And
They
I don't
just-
know what it is.
I would tell you if I knew, but I don't
Yeah.
know. There's a lot of black box stuff that's involved with this, so.
Sure.
We're not seeing that much variation anymore right now here locally anyway. I mean, we'll see maybe 4 cents, not 15.
So the part of it that's interesting on this is, again, it's just risk management. How much management do you want to do on this risk? You know, it's kind of like on you guys' milk, you know. If you put a call in the corn and a foot on your milk, you know, you might be able to, that's kind of what that livestock gross margins does. But it doesn't work very well, in my opinion, and our company hasn't sold any, not even in Iowa.
You also can't take an opposite position on the board in this.
Well, you can't.
Yeah, so if you're in this, you can't place the call on the other side.
Okay, any more questions on livestock risk protection?
We should
My
pound
sales
through,
pitch,
What's that?
good stuff.
yeah, we should pound through some crops too, though. Just
Yeah, we
just to
will.
see
We
what it's
can
like.
do that.
Okay.
Okay, the next one that we sell that is, I touched on it briefly about the pasture rangeland and forage. Wyoming is different than Montana. Wyoming is 4 mile square grids. It's on vegetative where the satellites fly. It's in 3-month increments. The coverage is, in Montana, it's based on rainfall. Those grids are a lot bigger, they're what, 6 by 8?
11 by 11, well, it's a 0.25 degree grid, sorry, it's the egghead portion, but
Yeah,
it gets
so
bigger as it goes to the Canadian line. It's 16 to 18 miles north to south, but 11 miles east to west.
Yeah. So the grids are bigger, but it's based on rainfall. That one seems to work better. However, if you're in Carbon County, for example, and you're in the Belfry area, which is the driest part of Carbon County, if the rain gauge happens to be up on the ridge at Red Lodge, it may not work any better. So we have paid some huge indemnities, $45,000, $50,000. But, you know, again, it depends. How much management of your risk do you want to do on this? Is the only way I can say it. Now, which crops would you guys like to look at? Let me explain to you a couple points and then we'll go from there. Fall crops are winter wheat, which we don't have available in Park County. But if there's somebody from Montana, we have it. have winter wheat available. In Park County, what we have available is forage production. Alfalfa forage production is a fall crop, and so is alfalfa seed, if you're raising alfalfa seed. Spring crops, you can actually put a spring seeded forage program in. And what that does for you is it's strictly for winter kill. Because you can't insure a product, a crop of alfalfa hay until it's gone through one winter. So it's got to be an established one. So if you've had difficulties with drought or some kind of, shouldn't have drought here because we're here, but something that's killing winter kill, you've seen it in your lifetime.
Sure.
So the new seeding is a spring crop. Now, there's some complications to it. You can seed it with oats, if you plant 16-pound oats as a cover crop, or without a cover crop. That's the two ways that you can cover this forage seeding. If a winter kills, they'll pay you and go forward. Now on the APH, on the forage, in your case where you guys have been farming long enough, we could go back and take 4 years of production history and say section 13, 99, 105 or whatever, in that field right here, you have a 4-year history of 6.5 tons. Then we could show you where you would be. We can do the same thing with barley, corn, corn grain, corn silage, any of those kinds of things. So name your poison.
So it doesn't have to be a cash crop, it can actually be a forage crop,
Yes.
as long as you've got the histories. The yields.
Well, let's say that one of your sons steps out on his own and is going to start farming. You can actually do a new producer and give them 100% of tea yield. So they're not, if you have production but no history, then they're going to say, well, we'll go ahead and insure this, but we're only going to allow you 60% of the transitional yield until you get 4 years of your own production. So it is a punishment if you don't keep good ground. Barley, corn, wheat, alfalfa, what do you want?
Corn.
Corn? Silage?
Silage.
Okay.
Got it right with everybody?
Yeah. Good as another one. Great.
You can see the list of things that's available is quite long.
There's no citrus trees. in
But there
Wyoming.
aren't any orange trees around.
Or pineapple. I tried to get them to put pineapple in.
I think we ought to figure out a way of raising pineapples in the greenhouse and insure them.
Yeah, how about you and I just go to Hawaii? We can just
That would be
check it
good.
out for a while.
It'd be cheap.
Yeah.
I don't see a big drought issue in it.
No, they're not gonna do that either.
We have not received the 2013 prices yet, so these will be based off of the 2012 prices.
This is a huge difference on it.
What yield do you want us to use?
Hmm?
Just pick a yield for us to use.
22.
Thank you.
It'd be fun to see what the yields are in the Midwest compared to West.
Well, you can go through the actuarial documents and pick out any county in any state, and they will show you that. Yeah, there's not a lot of silage grown. I mean, in a lot of those cases, it's all grain corn.
Yeah. Does that come from the census, or does that come from the USDA? How do they acquire that?
Well, probably from the Farm Service Agency,
Yeah.
the database that they're using.
How many acres were?
Use 100. We're going to use 100 acres, and the reason we do that is the computer actually rounds a little better. We're saying that it's 100% yours.
Just so the students know here, 22 is not really very good, but that's high elevation corn.
Yeah. Now this, you can see that the price is $43 per ton as far as their government price. Now, on these, you can protect this. Again, it's just like that livestock crest protection. You can pick where you want to be as far as your coverage. Goes from 50 to, you go 85% or more? I don't think so. From 50 to 75%. And what it does is in increments of 5%, and we'll show that for you here.
Oh, you don't have a rate yield in there.
What do you want us to rate?
One. Put 1. Oh, must be 100 then, huh?
No, it's still gonna be if their approved yield is 22, so the rate yield would be what the rate or what the yield is in the county, so.
Well, so probably 22. This is our RMA website. It's a little different than ours, and we don't use this one a lot.
And
But this one you guys can use, so it's.
yeah,
it's
the
available.
transitional yields and all that data now we have actual history from producers, and that stuff's getting plugged in, so we're using our RMA data, and that's where they're getting the transitional yields after so many years of production. That's getting plugged in. It's not they use a lot of National Light Statistics Service stuff before they started being able to populate it with history.
I'm surprised they do forage, because, especially with corn, because there's so much difference in moisture content that it's hard to understand.
That moisture,
But it's,
how do they handle that?
you know, because
Well,
I really interested to see what.
if you
the end-
have a claim and you turn it in the adjuster's manual, they're trained, the adjusters are trained to look for those kind of things. And there's quality, like on grain corn, for example, if it gets froze early, it will never dry down. It just won't do it. So, and here's another thing while she's going through this. Let's say that you planted 100 acres of grain corn with the intent of combining it, and it's insured that way. And you get a light frost and it's not going to make it. You call up and you say, we're going to change this from grain corn to grain silage. Our adjusters have to come out and appraise it and say it would have made this amount of corn grain for you because you changed it. Once in a while we run into this. We have a crop of oats that somebody intended to take to grain. And like this year forage is just unreal, so they want to cut it for hay. You have to call us and say, Larry, we're switching this from oats to hay, and then our adjusters have to come out and appraise it and say, it would have made this many bushels of oats. Because if you don't do that, then you get zero production in there.
Sure.
You pay the premium anyway, and it's not a good thing.
They call it WOC, without consent. So you destroyed it without consent, and then you're charged the full premium, and then you also end up with a zero on your APH, which will then drop down what your history is.
How much debate you get in that kind of an adjustment? I mean, I can see it.
Or it
Great deal of
it'll-
variation in that.
it can drop your yield 10%. You know, and that would be tough to swallow if you weren't careful in that. So the answer to that is, if in doubt, call.
Yeah, this is a heck of
This is the only, and I'm not being mean to these two.
Yeah, you are.
This is the only part of this program that I don't like, because it's slower. You know, it just takes a while. And you don't want to get in a hurry, because if it's got this little wheel running, don't touch it. Don't touch it, you gotta start over.
This is the storytelling time, right, Larry?
Yeah, this is when you tell stories.
The rate yield is the coverage level times your approved yield, right? That's, so it should, if you were, yeah, actually, we don't use it either, so.
Yeah, I'm not sure why that feels in there.
Well, you guys sell it, so we're the complaint department. When Larry sold you something, you're mad at Larry, then you call me and complain about Larry, and then I.
What's your name? No.
Yeah. Joe.
His name is George.
Yeah.
And he lives in Fargo, North Dakota.
Yeah, right.
Drive up and see us anytime.
You know, and the part that's interesting in this, whether it's those guys or us, what we're all trying to do with this program is to make sure that you understand what you're buying and that it's going to fit your risk management. You want to transfer it, in other words, buy your choice, you can do what you want. And then when this comes up, and we'll be able to show you, you can look in here and say, oh, the sweet spot here is 65% coverage, and at 65% of the coverage, I can still survive and be okay. Or no, I want to actually have the 75%. We have one that's called cat coverage. It's kind of like the NAP coverage on some things. It's 50% coverage at 55% of the price. So in corn silage at $43 would be, what, $20 a ton? And if your history's 22 ton, it'd cover you 11 ton at $23. They say it's free because it's fully government subsidized, but it costs $300 a year for processing.
Are you told how to, how can I say this? We measure every third or fourth load. We don't measure every load. I mean, you dictate to us how we measure if we feel like we're going to be able to claim or?
I think if you're, you know, because I grew up on a farm and I know that the chopper guys, you usually load them fairly close and you're not going to have 1% difference between them loads. And I think that's adequate records.
Depends on the field, because
It depends on the field, and then they're gonna do, the loss adjustment standards, and loss adjustment standards handbook for every crop. Whether or not it's wheat, or sorghum, or silage, or probably, I've never seen one for citrus, but there's one for them too. And then you get your pile, and then they're going to measure out that pile. And then they will be able to pretty close come up with what it is, of how many tons is from the pile. The same thing when they go and measure any storage facility for grain, corn, or wheat, or barley, or whatever, and whether it's an old wooden one or an oblong shape or whatever it is, we've got the mathematical formula in the book, and then the loss adjuster does that to find out how much you've got.
so they actually come and measure the finished product in the pile form.
Right.
Yeah.
Now there is also, like in forage production, when they're looking at bales and tons, they're going to be, you got to weigh a certain amount and know what the weight is and count how many bales and all that type of stuff too. I mean, they're going to.
So if you had, let's say you had 3 trucks, a red one, a green one, and a blue one. The chopper operator's writing red, green, blue, and he's putting the number of loads down. And then you've got the weights on these. As long as it's something that works with your operation and it's accepted by the adjusters, you're fine.
It wouldn't be an advantage to not reporting for our own the weights that are there anyway. I mean, you need to know what you've got in inventory. There'd be no advantage, but I just wondered if maybe with the government there was some kind of.
I'm tickled to death you said that because you're not trying to play a game.
Yeah.
There are people that try to play a game though, and we're not going to tell you how to play the game because that defeats our life. It makes my life miserable. But there's always somebody trying to.
Here's what we've seen, and I know these guys have seen it. Got a large farming operation, the guy's a crook, and he has 250 acres of corn silage, he puts 50 acres of
Put 16 and a half.
bit,
Right here?
Yeah.
and 200 in a different bit. He goes, and I got a claim. Doesn't tell about the other 50 down in a different spot 2 miles away or something. And when they catch him, you go to jail. And they should.
Oh, really?
They should, so.
Well, they don't give us handcuffs and badges or nothing, but I mean, we could.
No,
You get on a bad doer list, and you get, then everything's getting audited and all that, and it'll make your life miserable for a while. And there is always the opportunity to mess up bad enough that you end up in jail. It is a federal program, and it is fraud if you're doing that, and I wouldn't suggest that you do that. We had that thing's still spending away. We had a large claim in North Dakota that we were fighting. That thing is not going to work for you, Larry.
It's not
But it's just what.
And a guy's trying to claim for plans on something, and he is going to get eventually, if they don't settle, of course they always do that, but he could get to see the Crowbar Hotel over the door. But, so it's not something to fool with if you don't.
Oh, there you're asking me again.
Just be an honest Wyoming rancher farmer and you're fine.
Well, now, just out of I mean, we don't really have to bring that up. We can go into commodities if we need to, but if it'll work. But I guess I was just looking at, I wanted to see what the end date would be on a contract with 4-H corn. I mean, that's our big problem. We figure any time after the end of August, we're living on borrowed time for frozen corn silage, okay? And then we watch that percentage go down, that moisture percentage drop pretty fast. So what would be the end date of a contract on 4-H corn? That's what I'm looking at.
Okay, so that's your normal harvest date instead of your, there's always normal plant and harvest dates for any commodity. So it's just what the average harvest price is. There's a frost date for a lot of stuff like, for potatoes or whatever. Well, I don't know what the frost date is here.
I'm not sure either.
In the if there's an actuarial document, but they're going to say, this is the date when you're normally harvesting. And then if something happens because of a freeze or whatever that's early, then there could be an indemnity due. But it's not like a contract date like you would think of if you're dealing with the futures option, something like that.
Okay.
And the other part of it is, corn silage has a different insurance period than corn grain. Corn grain, the end of the insurance period is December 10th. Corn silage, it's like September 25th or something. But nobody chops corn silage corn in December,
No,
you know.
not unless you have.
And there's, yeah, see here, yeah, this you can go from 50% to 85%. Yeah,
a couple years ago, remember that down there?
Betsy did this ET10 here. What this prevent planting does is, we haven't seen it here as a problem, but over in Inland where the sunshine and those guys, they don't have water. And they actually can't, the irrigation district says, we don't have enough water for you to plant your beets, then you can do a prevent plant. But I'm telling you, you talk about hoops jump through it, you gotta really, really do that. But there is coverage there.
They're also, Larry's showing you the Farm Bureau one. There's no difference in price between companies. So if you go to Rain and Hail or any of you or
John
whatever.
Deere, rural communities, any of them, if you pick the same tons, same coverage, all that, the price is exactly the same. I like to say what you get is smile your face instead of their pretty.
Well, we're quite fortunate here in this area. We do, the two risks you have with corn, or with any crop really, would be hail or early frost. And so, if we could get this pinpointed, it could be really beneficial to us, because I've picked corn, I picked sweet corn in snow drifts.
Oh, yeah.
Before the end of August before.
Yeah. See right here, this is the 50% level, the 100% price. So they're saying on a 22-ton history, they're going to guarantee 11 tons, $43, which is $473 an acre. That's $6.57. Down here on the PT10, see the difference there? What this does is, if you were in a prevent plant position, it adds 10% to the coverage. So we're going to take this one here. They're going to say that on the 85% level, we're going to guarantee 18.7 tons. So if you had a frost or something that caused you, or a hailstorm, and we had a hailstorm up in Fromberg a couple years ago that just was awful. I had never seen a hailstorm pull out grain corn before. That one did. It was crazy. So let's say that you drop to 13.7 tons, so you're 5 tons short. They're going to pay you $215 an acre. It costs $62. You got your calculator on?
But I
Pull one up right quick and take $62.17 and divide it by 804. Costing you not quite 8%. Do this one here at the 65% level, Betsy. Take 1567 divided by 615. see how much less it is? Here's why. Government subsidy is more here than it is here. So as you buy more coverage, the subsidy is less and you're paying for more of the coverage. Okay? And there's a chart somewhere, I don't have it with me, but I can show it if you're interested in it. So you can go from $473 an acre at $6.57 to $804 an acre at $62. That's how that works. So in most scenarios, what we would want to do is, where are you at here as far as dollars per acre that you need to cover yourself for, because that's what we're looking at. Now, from a sales standpoint, we love to sell this. But since we want you to come back next year, if this is where you want to be, this is where we want to sell you.
That looks like the best bang for your money, you know, right up in that.
Right in, yeah, 65 to 70, right in here is, tends to be your best. I call it the sweet spot. So if you got a quote from Coando Insurance or John Deere or Jim Jarrett or me, this quote right here on this example would be exactly the same. Okay. Any other crops? Anybody interested in something else?
What's the thinking behind all this, though? I mean, how long has this been in play, crop insurance?
It's been around a long time since I was a little guy.
Well, they've tried it through the years. A lot of private companies tried it since the 30s and 40s, but a lot of them went out of business in the 30s because they didn't see that coming. The government's been in the business easily since the last 30 plus years. And it was always just on the main commodities, corn, wheat, soybeans, that type of stuff. And they slowly branched out. And now you can insure camelina in Montana, you can insure buckwheat in North Dakota, mustard, canola, grain sorghum, all these different crops. So it's expanding all the time, but it's layers of complexity each time they add something new to it. And then you've got other things that you can do with this. He was looking at optional units, which is by the section. You can do basic units, you can do enterprise units, different way of structuring. Enterprise units are all your crop of that type in the county, and then it's a steep discount on the premium. It'll drop you down 75% of the cost. So, I mean, it depends on what the crop is and stuff. So, I mean, you've got all sorts of different options.
The only problem with those kinds of things is your probability of a claim as you do those goes this way. If you have optional units with an 85%, your optional units, 50, 55, 60, 65, 70, 75, 80, 85. Obviously, at 85% coverage, you're going to have more of an opportunity to get an indemnity than you are at 50. Sure. But that's not what we're here to do. We're here to visit with you and ask you questions, and you educate us as to what it is you need, and then if you only need 60% coverage, that's what we need to do, is make sure that you're optimizing your risk for your particular operation. That's exactly what it is all about. And to me, I would define multi-peril crop insurance as, you can't make any money at it, meaning if you have a claim, you've lost money, it's specifically designed to keep you in operation for next year. That's the way I see it. And if you're trying, and here's the other part, if you're actually trying to make money off crop insurance, these guys aren't going to let it happen very long.
So rangeland in Shawmut, Montana. They just take the satellite.
Shawmut, Montana is rainfall.
And that's right, rainfall. So it strictly goes by rainfall over the last 4 or 5 years. I mean,
No, that was since 1948.
Oh, 48. Okay.
And then Carol punched me because of that's my crop, and it gets really complicated really quickly. I'm going to do a demonstration on it tomorrow as well,
Okay.
on either PRF, or vegetation or rainfall. Rainfall is an interpolated database. Interpolation is getting points that are further away to assign a value across your grid. And, you know, pretty fancy term. They don't know where, they don't show you exactly where each one of those data collection points are, because they don't want you to walk out and put your head over top of it and say, well, it didn't rain over here. So they're not gonna tell you exactly, but there is a minimum of like 8,000 across the country, the nation, but every single day, but most time it's 25 to 28,000 data collection points every single day. It can underestimate the non-rain events. So it's saying, well, it's not saying that there was, I guess it's not factoring in that there wasn't rain in a certain area. And then there's also, we have gully washers that dump a whole bunch of rain down in a short amount of time and moves on. Those add against you. The bucket is empty at the start of the interval, which is 2 months instead of 3 months in the vegetation. And then they look at it at the end of the 2 months, this is how much rain you got. It's calculated every day from the Climate Prediction Center of the National Oceanic and Atmospheric Administration, which is different than what you hear on the radio. That's the National Weather Service, not the Climate Prediction Center.
So the gully washer actually doesn't help you.
It doesn't help you.
It doesn't even, it plays into the calculation that it actually did.
Yeah, it washes out your creek crossings, it washes out the reservoir, and counts against you for rainfall.
And here's part of the vegetation that we have here to stop. Most of our indemnities that we have paid is because of too much snowfall. That can be a good thing. Satellites flying, they don't see anything. Can't see anything, there's nothing there, it's all white. You don't see anything, you don't see anything. Forest Service is telling us, guys, you can't go on because there's too much snow, you can't go on because there's too much snow. Then as soon as it melts, then there's grass like this, which is awesome. You can go up there, but then the opposite's the same thing too. Let's say that you were up there on a forest permit or out here on the BLM or something, there's a big old sagebrush fire that goes around there and burns a big old chunk of that off. And it was lightning caused, and so right after the fire gets done burning, it rains just a little tiny bit, green's up. Here comes the satellite, and that's green. It's beautiful.
Yeah, they're not gonna let you go in there until next year.
You know,
Well, the satellite can't tell the difference between cheatgrass and sagebrush and western wheat or anything, or a tree. They're doing a better job. The vegetation index in Wyoming had a loss ratio of about $4 this year. The loss ratio we calculate is for every dollar that you pay in, we pay out a certain amount. It's supposed to be at the ideal is it's a 1. For every dollar you pay, we pay $1. Well, for every dollar you paid, we paid out 4 in Wyoming. They call it an NDVI reading, and normalized differential vegetation index. That's what the satellite's reading. There were single-digit readings in central Wyoming this year, which no shock to anybody that went over there.
Yeah, right.
Yeah. So I mean, there was huge indemnities in Wyoming, but we found out that they blacked out the winter months, so you can't insure the winter because it's really not supposed to be growing in Wyoming in the wintertime. So you kind of concentrate your dollars, and then we're finding out that really it's when that grass is matured that you want to put your dollars. So later, kind of midsummer, late summer is when you want your dollars, because in the spring it's always going to have that hyper green response that's going to have a big spike. But the vegetation index is only the history since 1989 because the satellites weren't up before then.
This is kind of an off-the-wall question, but are these the same satellites that you know, they've been promoting in the ag magazines that tell you what sections of your places should be receiving more water or less water, or with the GPS and stuff? Is it the same dang satellites?
I don't know.
I'll bet they are. They must be.
There's a lot of satellites up there, and we got one of the guys in our Topeka office is close to being a rocket scientist, literally. He loves this stuff, and he goes, oh, well, that satellite does this, and I have no idea. I'm a blacksmith, not a computer guy. I have no idea. So that's not how that works for me.
So if you've got a permit on the Bighorns, this is a good deal.
could be.
Because there's a lot of years you guys go up late, isn't it, Morgan? I mean, they hold you out for snow and stuff.
It can be, except in the Bighorns they have trees. And the trees are always going to show as being green.
Evergreens or
Ever-
evergreen?
Yes. That's why the program, when it first started, it just started in a few states, and on the eastern seaboard, they had the vegetation index. And then somebody had a bright idea, geez, we haven't paid anything out, and it's dry, you know, I always hear Georgia's completely grouted out, there's nothing over there, but it's always showing green on the NDVI because of, it'll show you how things turned out, and there's a swath right down the bighorns that didn't have the losses right on the top of them, because there's trees.
Yeah. Any other crops, any other questions? Betsy, you have anything you want to add? All right, well, thank you, guys.
Well, thank you, Larry, that was good.